Most traders use liquidity wrong, but what if I showed you how to spot it on the 5-minute chart before the price even starts to move? This is the very same concept that I taught you on the daily time frame, but this time we're diving into the sniper zone, where reversals happen fast and fake outs are fatal. Papu84 says, you did a video for liquidity, but it was in a higher time frame. Can you please make a video for liquidity with 1-hour entries on a lower time frame? Absolutely, bro. Let's get into it. Today, I'm going to show you exactly how to identify lower time frame liquidity, identify all of the traps, and nail the reversals with surgical entries. Everyone loves trading zones and levels, but they miss what really causes price to reverse. Liquidity hunts. Market makers push price into liquidity to fill large orders, period. And they do it fast, so you can capitalize on this on the 1-minute and the 5-minute chart. If you can spot where retail stops are sitting, you can anticipate where the price is going, not react to it. Liquidity is areas where traders get stopped out or trapped. On the 5-minute chart, it could be wicks or a swing high, equal highs, clean support levels, all magnets for price. Your job? Find where the obvious trades are sitting and do the opposite. The key is to look for clean price action that's just a little too clean. Equal highs, trend lines, or zones that look perfect. That's the bait. Now here is the step-by-step process on how to spot lower time frame liquidity pools. Number 1. Mark the higher time frame liquidity zones first. Start with the daily or the 4-hour chart. Mark the most recent swing highs and lows and clean levels that haven't been tapped yet. This is how you would mark up the chart. You get it out to the daily time frame, take your horizontal position tool, and mark up all of the levels of support and resistance so that you can have an easy visual representation of the higher time frame support and resistance levels. Then you can identify areas that have not been tapped yet where the liquidity should be living. Drop to the 5-minute or the 1-minute chart if you're feeling a little bit risky. Now zoom in. Look for price rapidly approaching a zone. You want to see volume spike, a quick tap, and a rejection. Now that we have the chart on the 5-minute time frame, you are simply waiting for one of these levels to be hit, and then you're looking for that rejection wick. And because you waited for that zone to get hit and looked for that rejection there, you can get into your scalping trade and get a 1 to 2 risk to reward setup. Keeping in mind that if price rejects the same area twice, it could be a full reversal double bottom with the bar not closing below the area of support and resistance that you marked up and getting another trade 1 to 2 risk to reward ratio. Number 3, look for traps. Price will often wick above resistance, pause, then dump, or wick below support and reverse. That is your confirmation. And this is an example of that trap. Price came down and wicked below that level of support and then reversed. And again, as it was coming up, wicked above that level of resistance and came crashing down. Always keep an eye out for the traps. And number 4, use volume or candles for entries. Look for exhaustion candles, long wicks, bearish or bullish engulfing, or a volume divergence. Now, let's break this down on a real trade I took using this method. As you can see here, I've marked up the higher time frame zone on the daily time frame. So starting at the week's open, we could see this huge gap and the price dipped below that level of support that I had already marked up on the higher time frame. And during London's session, you could see the price started to come down to that support zone a little bit more. Now zooming in, you can see we had rapid price movement to that zone, an engulfing candle, which both of these candles were with wicks, and then we had that rejection up. That's when I was able to enter my trade at 0.61408 on Australian dollar US dollar. I kept my stop loss below the current London low, and all I had to do was shoot for a 1 to 2 risk to reward ratio. This was using higher time frame support and resistance and being able to scalp it on the 5-minute time frame with anticipation of price movement upwards because of the huge gap that was left over the weekend. So I have some bonus tips for you. Number 1, avoid entering before the price taps the liquidity zone. Wait for confirmation. Number 2, use session times like the London or New York Open. That's when the most stop hunts happen. And number 3, do not chase the breakouts. Wait for price to trap traders and fade the move. Lower time frame liquidity is one of the most powerful tools you can use in your day trading, but only if you know what to look for. So if you have a specific question in day trading, leave it in the comment section down below. And if you got value out of this video, make sure you drop a like on your way out, and we will see you in the next one.